Norwegian Cruise Line Holdings, 3 cruise brands, 32 ships, and over 600 destinations spanning every ocean on Earth.
The company traces its roots to 1966 when Norwegian Caribbean Line launched in Miami with a single vessel and a vision for bringing accessible ocean travel to a mass audience.
What made Norwegian famous was freestyle cruising, eliminating the rigid dining schedules and assigned seating that defined every other cruise line operating at the time.
That flexibility became a genuine product differentiator, attracting guests who wanted the amenities of a large cruise ship without the regimented schedule of a traditional sailing.
The company went public in 2013, and the following year made a transformative acquisition, buying Prestige Brands, the parent of both Oceania Cruises and Regent Seven Seas Cruises.
That single deal created a 3-tier portfolio: mass premium Norwegian, culinary-focused Oceania, and ultra-luxury all-inclusive Regent, covering virtually every wallet in the premium cruise market.
Revenue in the most recent quarter reached $2.33 billion, with Norwegian brand generating roughly 2/3 of the total, and Oceania and Regent contributing the rest.
Occupancy consistently runs above 100%, a cruise industry metric that accounts for the practice of fitting more than 2 guests per standard cabin on many vessels.
The competitive set is just 2 other major public operators, Carnival Corporation and Royal Caribbean, making this a 3-player oligopoly with high barriers from fleet scale and port infrastructure.
No direct competitor runs 3 brands spanning the full range from mass premium to luxury under one operational structure. That portfolio breadth is NCLH's clearest structural advantage.
The balance sheet carries over $13 billion in long-term debt accumulated partly to survive the COVID shutdown when the entire global fleet went dark for more than a year.
The full fleet returned to service by 2022, and travel demand recovery has been strong, but debt servicing costs remain the key financial overhang that investors track most closely.
The network includes proprietary destination stops like Great Stirrup Cay, where guests spend entirely within the company's own retail, dining, and excursion ecosystem, a captive revenue stream.
CEO John Chidsey took the helm in 2021, bringing operational turnaround experience from leading Subway through a complex multi-year global franchisee restructuring.
Market cap sits near $7.8 billion, a meaningful discount to book value that reflects both the debt burden and ongoing sensitivity to consumer travel spending cycles.
The advanced booking window extends well over 12 months on most itineraries, giving the company unusual revenue visibility compared to most consumer cyclical businesses.
The investment case centers on whether deleveraging speed and net yield expansion per passenger day can outpace interest costs and macroeconomic pressure on discretionary travel budgets.
With 41,000 employees and ships calling across 7 continents, Norwegian operates at a scale of complexity that smaller cruise entrants simply cannot match.
That is Norwegian Cruise Line Holdings, a 3-brand cruise operator with premium heritage, significant scale, and a multi-year debt restructuring story that defines the investment thesis. I'm Hudson.
And I'm Lana. Thanks for joining us on Charged Alpha, the S&P 500 stock encyclopedia.
Norwegian Cruise Line just delivered a Q1 2026 EPS beat, 23 cents actual versus 15 cents estimated, a 53% upside surprise. Revenue came in at $2.33 billion above the $2.26 billion estimate. The stock still dropped 9.3% on the session. Strong numbers, weak guidance. That's the tension we're breaking down today on Charged Alpha.
Norwegian Cruise Line Holdings is the 3rd largest cruise company on Earth, operating 3 brands: Norwegian Cruise Line, Oceania Cruises, and Regent Seven Seas. Founded in 1966 in Miami, the company pioneered freestyle cruising and today operates 32 ships with 41,700 employees worldwide. Market cap, $9.1 billion at roughly $20 per share.
The central question for NCLH right now: can the post-pandemic earnings recovery survive a macro slowdown and justify the $15 billion debt load? Management is delivering on operations. The EPS beat proves it. But the guidance revision spooked the market pricing peak cycle momentum. That gap between execution and expectation is where we focus today.
Q1 2026 headlines: revenue $2.33 billion against a $2.26 billion estimate, a 3% beat. Adjusted EPS 23 cents versus the 15-cent estimate, 53% upside. Both lines beat. The market sold it anyway, meaning the issue is entirely forward-looking.
Quarterly context. Q1 is seasonally the softest cruise quarter. Year over year, Q1 revenue grew 15.8% from $2.01 billion. That is real top-line growth driven by both volume and net yield expansion. The Prima-class ships and luxury Oceania and Regent brands are mixing up revenue per passenger cruise day above prior year levels.
Operating income for Q1 was approximately $420 million, an 18% margin. That compares to just 8% in fiscal 2023. Net income was roughly $101 million, with the net margin dragged down by $320 million in quarterly interest expense on the $15 billion debt load.
Cash flow. Q1 operating cash flow $150 million, capital expenditures $250 million, heavy new build spending, leaving free cash flow negative $100 million for the quarter. Trailing 12-month, OCF $459 million, CapEx $438 million, TTM free cash flow just $21 million. The new build cycle keeps near-term FCF thin.
Balance sheet. Cash $185 million, total debt $15.155 billion, net debt $14.97 billion, equity $2.43 billion. Leverage is roughly 7 times EBITDA, high by any standard. NCLH has been extending maturities and the debt load has edged below its peak as operating cash flow grows.
Annual revenue trajectory tells the recovery story. $4.5 billion in FY 2022, $8.7 billion in FY 2023, $9.6 billion in FY 2024, $9.8 billion in FY 2025, $11.2 billion estimated for FY 2026. Annual EPS went from negative $5.49 to an estimated $2.80. This company structurally rebuilt itself in 3 years.
Street consensus: 12 buys, 5 holds, 0 sells. Average price target $28, 40% upside from 1996. The analyst community is not running from NCLH on the guidance miss. They're treating the post-earnings sell-off as a buying opportunity, pointing to 7 times forward PE as the entry point.
Why did the stock fall 9% if analysts are bullish? Because full-year 2026 guidance for net yield growth came in mid-single digits, below the high single-digit pace the buy-side was modeling. Adjusted EPS guidance of roughly $2.80 for the full year represents 7 times forward PE at current prices. Cheap, but only if that guidance holds.
The forward PE comparison is stark. NCLH at 7 times, Carnival at 9, Royal Caribbean at 18, EV to EBITDA, NCLH 8.5, CCL 9.5, RCL 12.5. NCLH is cheapest across both metrics, valued like a distressed company despite improving fundamentals and strong demand.
The guidance miss has a specific driver: macroeconomic uncertainty tied to tariff policy and consumer confidence softness in booking patterns for 2027 sailings. 2026 itself is largely sold and priced. Occupancy is high. Management deliberately built conservatism into guidance rather than risk a subsequent downward revision.
FY 2026 forward estimates: revenue $11.2 billion, EPS $2.80, 31% earnings growth year over year. FY 2027 consensus models revenue $12.1 billion and EPS $3.60. If those numbers materialize, a 10 times multiple on FY 2027 EPS implies a $36 stock, 80% upside from current levels.
Bull case pillar 1, demand. Cruise bookings for 2026 are at record pace. Occupancy running above 100% with double occupancy, and net yield per passenger cruise day growing above capacity expansion. The structural demand for cruising is intact. Millennials are booking first cruises at record rates.
Pillar 2, pricing power. Prima-class ships command per-passenger revenue 15 to 20% above the legacy fleet. Oceania and Regent 7 Seas serve high-net-worth travelers for whom a luxury voyage is an annual event, not a discretionary cutback. The premium end of cruising is structurally insulated from mild consumer softening.
Pillar 3, margin expansion runway. Operating margin grew from 8% in 2023 to 18% in 2025. As the new build capex cycle peaks post-2027, free cash flow will improve substantially, converting operating cash flow directly into debt paydown, which cuts interest expense and compounds into EPS.
Bear case. Macro sensitivity. Cruises are discretionary. When consumer confidence breaks, booking pace slows and pricing evaporates. NCLH carries a beta of 2.1, meaning it sells off roughly twice as hard as the broad market. In a recession scenario, the debt service on $15 billion becomes a genuine concern.
Leverage risk is the bear case's strongest argument. $15 billion in debt against $9 billion in market cap. Debt is 1.7 times the equity value. If rates stay elevated through 2027, rolling maturing tranches at higher rates increases annual interest expense and compresses the EPS trajectory directly.
Fuel is the third bear variable. Marine fuel represents roughly 10% of NCLH's cost structure. A sustained spike in Brent crude compresses operating margin 2 to 3 percentage points with limited mid-voyage pass-through ability. NCLH hedges a portion, but an energy shock like 2022 would meaningfully undermine the guidance trajectory.
Geopolitical disruption rounds out the bear risks. Middle East conflict forced itinerary rerouting in 2023 and 2024. Caribbean hurricanes, Mediterranean instability, or a vessel health scare could materially disrupt forward bookings. NCLH's geographic concentration means single region events have outsized impact.
Royal Caribbean at 18 times forward PE earns its premium, stronger balance sheet, higher margins, faster EPS growth. Carnival at 9 times is the mid-range, reflecting greater exposure to budget travelers more sensitive to the macro. NCLH at 7 times is cheapest, pricing in more risk than either peer.
The NCLH discount is partly justified by higher leverage, more debt relative to market cap than CCL or RCL. But the discount also reflects that the market hasn't fully credited the margin improvement that has already happened. Operating margins went from 8 to 18%. The stock is not yet priced for that reality.
What closes the valuation gap? A sustained period of guidance beats rather than guidance cuts. Royal Caribbean trades at a premium because it has delivered consecutive guidance raises. If NCLH delivers 3 consecutive quarters of meeting or raising guidance, the multiple can re-rate from 7 toward 10 to 12 times, 50 to 70% upside.
The leverage differential drives the multiple gap directly. Every billion of debt retired from FCF reduces annual interest expense by 40 to 50 million and adds roughly 10 cents to annual EPS. Debt paydown is EPS accretion without any operational improvement required. The math is that clean.
Options activity into Q1 results showed a put-call ratio of 1.3 above neutral, reflecting caution around the guidance outlook. Put activity concentrated in the $18 to $19 strike range captured investors hedging against exactly the guidance miss that materialized. Post-earnings implied volatility reflects roughly 25% annualized vol, elevated, consistent with a high beta consumer discretionary stock.
On insider activity, no significant open market purchases or sales near earnings. CEO Harry Sommer holds equity through RSU vesting, interests aligned with shareholders. Institutional ownership around 70%, with large positions from value-oriented funds that entered during the pandemic trough. No unusual insider selling signals concern about the outlook.
Short interest in NCLH sits at roughly 8 to 10% of float. Elevated, but not extreme for a high beta cruise line. The post-earnings sell-off may have covered some of that short interest. If the next quarter shows guidance stability, a short squeeze could amplify upside movement above $22.
Catalyst calendar. Q2 results in late July give the first read on whether summer bookings are materializing at guided yield levels. Q3, the peak cruise quarter, reports in November and is the single most important data point for full-year EPS. Any Q3 upside versus conservative guidance would meaningfully shift the risk-reward on a 7 times earnings stock.
Bottom line, Norwegian beat on Q1 earnings by 53%. The stock fell on guidance conservatism, not operational failure. At 7 times forward earnings with a consensus buy and $28 target, the risk-reward is asymmetric for investors with a 12-month horizon.
Watch 3 numbers: net yield per passenger cruise day versus guidance, total debt balance for any reduction below $15 billion, and summer occupancy confirmation in the Q2 call. That's the NCLH scorecard for 2026.
Financial data and charts sourced from Financial Modeling Prep. Charged Alpha is for informational and educational purposes only. This is not investment advice. Always do your own research before making investment decisions. Thanks for listening to Charged Alpha. Subscribe and leave a review if this was useful. New episodes every earnings season. See you on the next one.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.